let me start with the Moody's decision. They maintained the U.S. AAA rating, but indicated that there's a negative outlook. This is a decision that I disagree with. The American economy is fundamentally strong, and Treasury securities remain the world's preeminent safe and liquid asset. We have enjoyed over the past several years an historically fast economic recovery from a deep recession. Our unemployment rate is near historic lows. Inflation has come down significantly, and our economy grew by almost 5% in the third quarter. Now, it's true that resilient U.S. economic growth has been a factor pushing up interest rates recently. That's something that reflects the fundamental strength of the U.S. economy, not weakness. Now, it is true that higher interest rates, if they last, do create a challenge, an additional challenge to debt sustainability. The President and I are completely committed to a credible and sustainable fiscal path. Given the strides that I just described and the strength of the U.S. economy, a shutdown is something that poses an unnecessary economic headwind in a moment when the U.S. economy is doing well and moving in the right direction. So it's critical that House Republicans do their job and work in a bipartisan manner so we sustain this progress. I know that discussions are active in Congress on trying to find a path forward, and the administration is engaging closely in discussions with Congress. I'm hopeful we'll find a satisfactory solution.
The Bloomberg U.S. dollar index off more than 1% or 14 points. It's the biggest drop that we've seen in this measure of the dollar in a year now. So the Bloomberg U.S. dollar index showing some gains for the euro and the pound and the yen against the dollar that seem to be like a loaded spring. Let's switch up the board and take a look at rates, because that's really what was the beginning of these moves. The big driver after inflation numbers came in the form of CPI, a lot cooler than had been anticipated. The U.S. 2-year moves down 20 basis points, the 5-year down 22, the 10-year down to 446.68. Remember, just October 19th, we were above 5% there. Yesterday, we were above 5% on the 2-year, and now we're down at 450, less than 450 on the 10-year, less than 485 on the 2-year. The U.S. 30-year is down 11 basis points to 4.6452. Some huge moves in yields, and that really has driven the moves in the equity markets as well. Here you can see a better shot of the 2-year and what we saw. As I said, trading for more than 5%. The yields were more than 5% before this CPI data came out, and then it just dives down at one point to 482 and change. We've been getting reaction all day long on Bloomberg to the U.S. inflation print. Here's some of what people told us the data means to the Fed.
We certainly see the early signs of a slowdown.
We're sort of gradually sliding into a softish landing.
Potential for a soft landing is still there.
Across the board, there's disinflation in the U.S. economy, and we're heading back to 2%.
We're probably past the point now, at least with conditions remaining as they are for the Fed to hike again.
The Fed is done.
The Fed probably is done.
That period of pause has now begun.
This is a fantastic environment where they're probably not going to have to do anything else.
Next year, they will begin to open the window to lower rates.
If they are confident that things are really going to slow down, then they can start to cut rates, maybe summer or so of next year.
And that all speaks to tighter financial conditions to the extent that there are more things that could break in this environment. What else breaks?
What else breaks? Are you looking for the next Silicon Valley bank?
I sure am.
So the risk in the banking system still lies in credit risk in middle tier banks, and in particular their exposure to commercial office is a big risk factor, less so their exposure to mid-sized enterprises. I mean, to be clear, to be a mid-sized bank today is a really tough place to be. The market for deposits is becoming increasingly competitive. The cost of compliance has soared over the last decade. The amount of technology that the consumer expects you to bring to bear to solve their problems comes with a pretty hefty price tag. It's a really tough place to be today as a community bank or as a mid-tier bank. And now you've got not only those headwinds of costs and expectations around customer service and customer experience, but you've got a credit cycle unfolding. So I think that's where the risk lies today within the banking system. First and foremost is in those mid-tier banks.
Now, does the Fed get to where they need to go without causing a deeper recession? Now, you've said before, pretty recently, that you would expect a recession at some point. And so,
well, I will be right on that eventually.
Eventually.
I mean, every economist is at some point right on that call.
So instead of asking you when, I'm going to ask you what it looks like.
So here's our best guess. Our best guess was sometime late this year. It's November. So we're going to be wrong on that guess. Q2 right now is roughly the center point of our distribution as to when we're likely to see the United States in a recessionary environment. And I think there's a couple of really important questions that will come into bear at that moment in time that should influence one's view as to how deep this recession is going to be. Number one is what's going to happen to fiscal policy in the United States. For choice, we think next year fiscal policy will not tighten that much. We're heading into a presidential election. It's really hard for politicians on either side of the aisle to do what we need to do, which is to rein in our deficit spending in front of a presidential election. It's going to be really hard politically to get there next year on that front. The second real question next year is how much will companies start to unwind the labor hoarding that we've seen over the last couple of years? It's been really hard to hire people. And as such, your large companies have been very reticent to let people go no matter what the circumstances are. So even if margins are contracting, even if you have gains from automation, people have been very reticent to let people go. Now we're starting to see for the first time the unwinding of that labor hoarding. What we don't know is how much of that labor hoarding has taken place. And then what worries me in a hybrid work environment or work from home environment, the cultural or social contract that holds people together in a company is unquestionably weaker. I mean, we've all read about companies that have fired thousands of people on Zoom calls. There's no sense of, that's Jane who's worked down the hall with me for years, and I'm going to go the extra distance to try to keep Jane employed here. It's like, here's the email to all, here's the video conference with a bunch of people, and goodbye. It's a very different moment in American employment history where I believe the bond between the company and the employee has become far weaker.
Continued growth in universal developer adoption. The other thing too, I think there's been, there's always been a flourishment of new ideas and new companies, but I'm finally beginning to see institutional adoption, which I think is something that was required and needed, and for that we need to have reliable, secure solutions, not net new that have not been tested. So I think we have gone through a period where we needed to prove that reliability, that scalability, and that the products and services are secure to actually tap into institutional funds and institutional managers that were required to not only sell to Web3 community, but outside of the Web3 community to institutional and enterprises.
Super quick computers and advanced mathematic formulas have largely taken over trading on the financial markets from human beings. Algorithms, which seem to have a life of their own. Algorithms secretly lie waiting for the moment that your Apple share or your pension money gets on the market. The only ones who understand this system in any way are its architects, the algorithm developers,